Welcome. Today we are going to break down a very disciplined trading plan for ServiceNow. If you're someone who values strategy over just pure speculation and you really want to capitalize on weakness, well, this is your blueprint.
So let's start with the diagnosis, right? ServiceNow is in a clear corrective phase. Its momentum is negative across every key time frame we look at. 4 weeks, 12 weeks, even 6 months. Now, this isn't a signal for some kind of random action. No, it's a very clear call for a precise plan.
And what's adding fuel to this fire is the stock's sky-high valuation. We're talking about it trading at a price-to-earnings ratio of over 100. In a strong market, hey, that's optimistic. But in a weak market like this one, that's a liability.
Let's just be crystal clear about this. Buying at today's price is a high-risk, low-reward gamble. The winning move isn't about being fast, it's about being disciplined. Our real advantage here comes from our patience.
Okay, here's how we're going to break it down. First, we'll look at the current situation. Then, we'll get into our core strategy. After that, we'll pinpoint the 3 key price levels, detail exactly how to execute, and finally, outline the winning profit potential.
First up, the current situation. Before you ever make a move in the market, you absolutely have to understand the terrain. So let's assess the risks and the opportunities here.
Okay, so let's just review the facts on the table. We've got that negative momentum and a premium valuation. But here's the wild card. There's an upcoming 5-for-1 stock split. Now, a split doesn't actually change the company's value, but it almost always attracts a new wave of attention, and that creates price swings. That volatility, that is exactly what our strategy is designed to exploit.
And this leads us right to our core strategy. We call it the support swing. It's a really disciplined approach, designed specifically to turn this market weakness into our strength.
Let me be very, very clear about what this means. We are not chasing the price higher. We're doing the exact opposite. We are patiently waiting for the price to come down to a strong, predetermined technical floor. Think of it like a historical price where buyers just consistently step in. We are buying weakness at a specific level, not strength.
And, the power of this plan really lies in its risk-to-reward profile. By predefining our entry, our stop loss, and our target, we create a setup where the potential reward is 3.5 times greater than our initial risk. That's the kind of asymmetry, the kind of math that we're always looking for.
All right, now for the most critical part, the numbers. These are the exact price levels that are going to define our actions. This, right here, is your blueprint.
So this table, this is our complete game plan. It shows both the pre- and post-split levels. But with that split right on the horizon, we're going to anchor our whole strategy to the post-split numbers. These are the 3 figures that matter most.
So the first and probably most important question is, where do we even look to buy this stock? At what price does it finally become attractive? Our target entry zone begins at $160 post-split. And listen, not a penny higher. This is our line in the sand. So, why this specific level? It's not just a random number. There are 3 solid reasons. 1, it's a proven historical support floor. 2, at this price, the valuation becomes far more reasonable. And 3, and this is a big one, it's the level where insider selling has historically just dried up. The market itself has basically validated this price as a fair entry point.
Okay, so we know where we want to get in. But what's the very next question that every single professional trader asks before they enter a position? It's this: how do we manage our risk? Where are we wrong? And how do we protect our capital if this thing goes against us?
Our stop loss, and this is our non-negotiable exit point if our thesis is wrong, is set at $149. That's an automatic sell order that protects us from any larger losses. Now, this level serves 2 really important purposes. First, it strictly limits our potential loss to right around 6 or 7%. And second, it acts as a circuit breaker. A clean break below this price is our signal that the market dynamics have shifted and it's time to get out, no questions asked.
And finally, the fun part, the profit target. Where do we exit if the plan works? A professional strategy needs a defined exit just as much as it needs a defined entry. The target for taking our profit is $192. This is the goal of that snapback rally we're planning for.
The rationale here is simple. Selling at $192 locks in a really solid 20% gain. And, critically, it aligns with a major technical resistance level. You can think of it as a price ceiling where sellers tend to show up. In a weak market, you just don't get greedy. You take your profit at the first sign of trouble. That is the winning move.
Okay, so now let's translate this entire strategy into a concrete set of actions. Because, a great plan is totally useless without disciplined execution.
The execution is actually really simple, and it starts with what you don't do. You do not buy today. Instead, you set a limit buy order at your price, $160.50, and you wait. You let the market come to you. Your greatest strategic asset here is patience.
All right, so let's bring it all together and summarize this entire winning strategy. This whole plan is built on a single foundation: discipline. The key takeaway is that successful trading isn't about being right on the timing, it's about being right on the price. Look, the market may take weeks, it might take months to reach our level. The ultimate question really isn't about the stock, it's about you. Do you have the discipline to wait for your price?